Here's a question. If the market dropped 20% tomorrow, would your life actually change? For many people, it would. Not because they're active investors, but because their savings and future plans are tied to the market without them even realizing it. For a small group of investors, not really, because their income doesn't depend on the market being happy. How do they pull that off? Today, I want to walk you through 3 monthly ETF strategies that show exactly how to get $8,000 per month in passive income. I will show you 3 portfolios, a conservative one for investors who are starting early, a balanced strategy for investors who have slightly less time, and in the end, I will show you an aggressive strategy that can hit the $8,000 per month target 10 years from now. Before we get into the strategies, it helps to understand why income investing has become such a big deal. Every major financial crisis has taught the same uncomfortable lesson. Growth without income is shaky. Back in 2008, the housing crash wiped out retirement accounts that people had spent decades building. In 2020, the market dropped almost a third in just a few weeks. Then in 2022, inflation and rate hikes crushed tech stocks and erased gains all over again. For millions of investors, those moments were wake-up calls. Chasing stock price gains suddenly felt unreliable. That's when many investors started shifting towards something more dependable: monthly income from dividends, especially through dividend ETFs. Even during 2020's chaos, U.S. companies paid over $503 billion in dividends as per Janus Henderson's Global Dividend Index. Just 3 years later, that number hit a record high, $602 billion. Markets were swinging like crazy, yet companies kept sending checks to shareholders. That's the part dividend investors care about, income that shows up no matter what the headlines say. No guessing, no timing, just steady cash flow that can be reinvested and allowed to compound into something much bigger over time. And once you see how predictable that stream can be, you start to understand why dividend ETFs have become such a core tool for people who want stability and growth at the same time. So let's take a closer look at what makes them work and why they become the backbone of modern income investing. Dividend ETFs are collections of dividend-paying companies packaged into a single investment. Instead of buying individual stocks, investors can own one fund that provides automatic diversification, professional management, and regular income distributions, often monthly. When you buy a share of a dividend ETF, you're getting a slice of hundreds of profitable companies that consistently share their earnings. When you put them together in a single fund, the income becomes much more stable than anything you'd get from owning a handful of individual high-yield stocks. The daily market noise matters a lot less when your portfolio is built on companies that actually pay you. Monthly dividend ETFs typically yield between 4% and 10%, depending on risk and sector exposure. That means an investment of $100,000 can bring in $4,000 to $10,000 a year, or roughly $330 to $830 every month, and your original money stays invested. And the real strength shows up when you reinvest those dividends. Each payout buys a little more of the ETF share, and those extra shares start producing their own dividends. Over time, that snowball effect builds on itself. Dividend ETFs also make your portfolio easier to manage. You get exposure to sectors like utilities, consumer staples, technology, and finance all at once, which helps smooth out the bumps. Instead of worrying about one company slipping, you're spread across many that are built to handle different kinds of economic conditions. With the foundation of dividend ETFs understood, the next step is defining clear stock selection criteria to identify the most reliable and rewarding ETFs for your strategy. Choosing the right income-producing assets starts with understanding what actually makes a dividend reliable. A big yield might look exciting, but a dividend only matters if it can be maintained year after year. The first thing to look at is the dividend yield itself. Very high yields often signal trouble, so the sweet spot for most balanced portfolios sits around 3% to 6%. It's enough to create solid income without hinting that the company is struggling to support its payouts. Then you want to see consistent dividend growth. When a company has raised its dividend for several years in a row, it's basically proving that its business model is strong and that it can handle economic ups and downs. The payout ratio matters too. This is the percentage of earnings a company hands out as dividends. Keeping it under 70% usually means the company still has room to reinvest back into the business and cushion itself during slow periods. When a company is paying out almost everything it earns, there's very little safety margin if profits slip. Cash flow stability is another big piece. Dividends should always be backed up by real consistent free cash flow, not borrowed money. If a company's free cash flow is trending upward over time, it's a strong sign that the dividend can continue and even increase. Sector resilience adds another layer of protection. Defensive industries like utilities, consumer staples, and healthcare typically hold up better in recessions, helping stabilize portfolio income. And finally, valuation. Even the best business can be a bad investment if you buy it at an inflated price. Ideally, you want companies with a price-to-earnings ratio below their sector average and a healthy return on equity, because that combination usually means you're paying a fair price for real efficiency and profitability. In a couple of minutes, I'll show you how to build 3 portfolios: a conservative one for investors who are starting early, a balanced strategy for investors who have a little less time using these criteria, and finally, an aggressive strategy that can reach the $8,000 per month target in just 10 years. To make this easier to follow, everything is organized into 3 income strategies, each one built for a different goal and timeline. They all use the same foundations: steady yield, healthy growth, and controlled risk, just arranged in different ways. Josh follows the conservative strategy. His plan stretches over 30 years, which means he doesn't need a huge starting amount. Time is doing a lot of the heavy lifting. His focus is on stability, slow compounding, and letting reinvested dividends quietly build wealth in the background. Jade takes the balanced strategy. Her timeline is 20 years, which puts her right in the middle. She wants a solid monthly income slightly sooner, but she also wants her portfolio to grow meaningfully over time. Then there's Jimmy with the aggressive strategy. He's working with a 10-year window and wants his money to grow faster. His approach leans into higher yields and quicker compounding, which means a larger upfront investment and a higher tolerance for short-term swings. The trade-off is speed. He wants to see big progress sooner. Each of these paths reaches the same destination: $8,000 monthly income, just at different paces and with different levels of risk and commitment. So let's start with the most patient of the 3 and see how the conservative approach begins to build momentum. The conservative income strategy is built for investors who value stability, consistency, and want to take full advantage of the compounding effect. Its purpose is to generate steady monthly cash flow and long-term wealth growth while keeping volatility low. Rather than chasing market swings, this approach focuses on sustainable dividends, disciplined growth, and reliable reinvestment that endures across decades of market cycles. This strategy uses 5 ETFs that each play a different role in keeping the income steady and the risk low. The first building block is the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD. Think of this as the foundation. It picks the 50 highest yielding, least volatile companies in the S&P 500. SPHD pays a 3.78% dividend yield, grows its dividend around 4.65% per year over 10 years, and its share price has appreciated 3.89% annually. It trades around $47.78 and holds 52 stocks, mostly in real estate, consumer defensive, and utilities, sectors that tend to stay calm when markets don't. With $3.02 billion in assets, a 0.3% expense ratio, and a low 12% standard deviation, SPHD has delivered a total return of 48% over the past decade, all while staying predictable and smooth. Next comes the Wisdom Tree US High Dividend Fund, ticker DHS. This ETF focuses on financially strong companies that pay solid dividends. It yields 3.42%, has grown dividends by 5.12% annually over the last 10 years, and its share price has appreciated 5.28% on average a year over the same period. DHS holds 365 companies across healthcare, financials, and consumer staples, names like Johnson & Johnson, AbbVie, ExxonMobil, and Chevron. With $1.27 billion in assets, a 0.38% expense ratio, and a 13.72 standard deviation, it offers moderate volatility and a 70% total return over 10 years. It's steady, dependable, and built to hold up during tough economic periods. The third piece is the Wisdom Tree US Large Cap Dividend Fund, ticker DLN. This one brings stability and growth. It yields 1.89%, grows dividends at 5.09% per year, and has delivered an impressive 9.11% annual price appreciation. DLN owns 305 big established companies like Apple, Microsoft, JP Morgan, and Nvidia. It has a 145% total return over the past 10 years. DLN adds long-term strength without adding much risk. To boost income, the strategy includes the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ. This fund mixes tech exposure with a covered call strategy to generate monthly income. It yields a strong 10.32%, grows dividends around 12.21% a year, and has appreciated 5.45% annually in share price. Since its launch, it has delivered 17.27% total return. JEPQ leans heavily on tech, about 55% of the fund, with companies like Nvidia, Apple, Microsoft, Alphabet, and Amazon. Rounding things out is the Invesco High Yield Equity Dividend Achievers ETF. This fund focuses on companies that have increased their dividends for at least 10 years straight. It yields 4.85%, grows dividends at 8.17% annually, and has appreciated 4.17% per year in price. PEY holds 52 stocks across utilities, financials, and consumer defensive, which gives it resilience during downturns. Bringing these ETFs together creates a portfolio that's both defensive and productive. The next step is to calculate the portfolio's overall metrics, starting with the dividend yield. Since we're keeping things simple here, we'll use a basic average, not a weighted one. That means we'll take the dividend yield from each ETF, add them together, and then divide by the number of ETFs in the portfolio. So let's walk through it. The 5 ETFs in this conservative portfolio have dividend yields of 3.78% for SPHD, 3.42% for DHS, 1.89% for DLN, 10.32% for JEPQ, and 4.85% for PEY. First, we add all of those yields. 3.78 plus 3.42 plus 1.89 plus 10.32 plus 4.85 equals 24.26. Now we divide that total by the number of ETFs, which is 5. 24.26 divided by 5 equals 4.85. That 4.85% is the simple average dividend yield for the whole portfolio. In other words, if you think of each ETF as contributing equally, the portfolio as a whole is yielding about 4.85%. You can do the exact same thing for dividend growth and share price appreciation. Average the 10-year dividend growth rates to get about 7.05%, and average the annual share price appreciation numbers to get about 5.58% for the portfolio. The next question is what these metrics actually look like when someone puts real money behind them, not with constant deposits, but with a simple one-time investment that's left to compound. For Josh, that starting point is a single $55,000 investment. The idea is to show exactly how far these averages can carry an investor when the only fuel is time and reinvested dividends. And $55,000 is a realistic amount for someone who saved aggressively or rolled over an older account, while still being big enough to show the long-term impact of this conservative setup. Based on portfolio metrics and Josh's investment amount, the portfolio value shows that after the first year, the total value is projected to be around $61,000, with roughly $3,000 in annual income from dividends. By year 10, the portfolio is projected to reach about $153,000, and the yearly dividend income is expected to climb to roughly $8,000. As we move out to year 20, the compounding effect becomes more visible. Projections show the portfolio growing to nearly $457,000, with annual income projected to be around $26,000. And by year 30, the portfolio is projected to reach roughly $1.49 million, generating close to $97,000 per year, or about $8,000 every month. Now that the conservative foundation is in place, it's natural to wonder what happens if you don't have 30 years to wait. What if your goal is closer, maybe retiring in about 20 years, or simply wanting your portfolio to grow faster while still keeping things steady? That's where the balance strategy steps in. And in the end, I will show you an aggressive strategy that can hit the $8,000 per month target 10 years from now. But first, let's see the balance strategy. This one is built for someone like Jade who wants a stronger mix of growth and income working together, even if the bulk of that income arrives later as the portfolio matures. This approach blends covered call income for steady cash generation, dividend growth power for long-term compounding, and a low volatility base that keeps things stable along the way. It doesn't swing for the fences, but it doesn't crawl either. It targets a middle ground where both growth and future income build at a healthy pace. So the balance strategy picks up where it left off. Instead of rebuilding the entire portfolio from scratch, we carry over a few ETFs from the previous strategy, the ones that already proved themselves essential. We keep SPHD because it brings the same steady, low volatility foundation that made the conservative plan so reliable. It's the piece that keeps the portfolio calm when the broader market starts shaking. And we include JEPQ again because its monthly income and tech exposure help maintain a strong cash flow without drifting into unnecessary risk. Both of these played a major role in the first strategy, and they fit perfectly here because balance still requires stability and dependable income. On top of those, the balance strategy brings in a set of new funds designed to add more growth and more income at the same time. The first major addition is the JP Morgan Equity Premium Income ETF, or JEPI for short. This fund is designed to turn everyday market volatility into cash flow through covered calls on large-cap stocks. JEPI pays a strong 8.36 dividend yield, increases its payouts by about 5.49% per year, and still manages 2.42% annual price appreciation. Since launch, it has delivered a 12.69% total return. Next is the First Trust Buy Right Income ETF, ticker FTHI, which adds another layer of option-based income through a systematic buy right strategy. It yields 7.94%, grows dividends at roughly 8.2% per year, and has appreciated 1.59% annually. Over the past decade, FTHI has delivered a 17.36% total return. With $1.73 billion in assets, a 0.76% expense ratio, and monthly distributions. It holds 213 stocks, including Nvidia, Apple, Microsoft, Amazon, and Meta. Its 9.38 standard deviation and A- liquidity rating keeps things balanced, making it perfect for this portfolio. For long-term compounding, we have the Wisdom Tree US Quality Dividend Growth ETF. This ETF brings in high-quality companies with strong profitability. It yields 1.37%, grows dividends at 7.26% annually, and increases in price at an impressive 11.01% per year, leading to a 192.73% total return over the past decade. Bringing these pieces together, JEPI, FTHI, DGRW, plus the familiar JEPQ and SPHD, creates a portfolio that has an average 6.35% dividend yield, grows dividends at 7.56% per year, and appreciates in price at about 4.87% annually. Here's what that means in real life. When you look back at the conservative projections, most of the growth showed up in the final 10 years. That's the strength of long timelines. They give compounding the space it needs to explode. But Jay doesn't have that luxury. With a 20-year window instead of 30, she can't rely on time alone. She has to give the portfolio more fuel up front so the compounding can start working earlier and build enough momentum. That's why she begins with a one-time investment of $90,000, so it can replace the decade of compounding she doesn't have. Using the portfolio's averages, after the first year, the balance is projected to be around $100,000, generating roughly $6,000 in annual income. By year 10, the portfolio is expected to grow to about $281,000, with yearly dividends projected near $20,000. And at the 20-year mark, the portfolio is projected to cross $1.06 million, paying close to $97,000 a year, about $8,000 every month. Now that the balanced approach is complete, the last strategy shifts into a higher gear. The aggressive strategy is built for investors like Jimmy, who want their capital working harder and growing faster over a shorter 10-year window. The goal here is simple: maximize monthly income, accelerate compounding, and squeeze as much growth as possible out of a limited timeline. It's a higher risk setup, but for someone with a shorter horizon and a stronger appetite for income, the trade-off can be worth it. Just like before, we don't rebuild the entire portfolio from scratch. We borrow what still works. JEPI stays because its high monthly income and lower volatility fit perfectly even in a more aggressive design. JEPQ remains because its tech-heavy income and covered call structure help boost cash flow without going completely off the deep end. And DHS stays because it brings the defensive high-dividend backbone that keeps this strategy from becoming unstable. These three were strong in the last two strategies, and they continue to earn their place here because aggressive doesn't mean reckless, it means intentional. Now we add the two new income-focused ETFs that push the strategy firmly into high-yield territory. The first new addition is the Evolve European Bank's Enhanced Yield ETF with the ticker EBNK. This fund brings something the previous portfolios didn't have: global banking exposure with double-digit yield potential. EBNK pays an 11.64% dividend yield and supports it with a 12.5% 10-year dividend growth rate and 9.49% annual price appreciation. With $100.6 million in assets, it invests entirely in major European banks like Santander, HSBC, Lloyds, and ING Group. Since launch, it has delivered a 43.05% total return with a 14.4 standard deviation and 133.6% turnover, signs of active management designed to squeeze income out of volatility. The hedge structure helps soften currency swings, making the income more predictable. In this portfolio, EBNK becomes one of the strongest yield drivers. The next addition is the Global X S&P 500 Covered Call ETF, or USCC for short. This fund enhances income using a consistent buy-right strategy on US blue-chip stocks. It also pays double digits, a 10.08% dividend yield, grows dividends at 8.28% a year, and adds 2.96 annual price appreciation. Since its inception, it has gained a 42.44% total return. When combined, these 5 ETFs, JEPI, JEPQ, EBNK, USCC, and DHS, form a portfolio with an average yield near 8.76%, a 10-year dividend growth rate of 8.72%, and 5.12% annual price appreciation. It's designed for investors who can handle sharper short-term movements but want to compress the time it takes for compounding to make a noticeable impact. Because of that short timeline, Jimmy can't rely on slow growth the way Josh and Jay did. If you look at the previous projections, most of the big growth happened in the later halves of the investment, and Jimmy doesn't have those decades to spare. He wants the same kind of monthly income the others reach, but much sooner. That's why he has to start with a larger one-time investment of $220,000. It gives the portfolio enough weight to compound quickly and produce meaningful income right from the start. With that upfront investment, the projections take shape fast. In the first year, the portfolio is projected to sit around $251,000, generating roughly $19,000 in annual income. By year 5, the dividends are projected to rise to about $38,000, while the portfolio grows to roughly $434,000, nearly doubling income and significantly expanding value in half the time. And by year 10, the projections show the portfolio crossing $925,000 while paying close to $95,000 a year in dividends, or about $8,000 every month. Want to know how much investment in SCHD you'd need for $5,000 a month? Click the video on screen to find out.